Welcome to Money Chic, Financial Education with Shari Rash, the podcast that's here to empower you with the knowledge and skills you need to master your personal finances and live your best financial life. Hi, thanks for joining me on Money Chic, Financial Education with Shari Rash. Today, I wanted to talk about investing basics. I am a writer for a blog called Charleston Moms, and every so often the writers will get together and they will share different ideas that they want to either talk about in their own blog or ask other writers to write about. And being the financial advisor in the group, the other writers wanted me to talk about investing, but like the very basics of investing. Like, I want to start investing. I don't even know what to do. How do I do it? Basics of investing. So I did it. I wrote a blog about that for Charleston Moms, and I'm going to share that with you today because if a couple of moms have questions on it, then many people have questions on how do I start investing? What are the very, very basics of investing? They asked me questions such as, I just don't get it. Or they said, I just don't get it. I don't get investing. Or they said to me, I'd love to invest, but I just don't know how to. They also said, we want to start investing money, but we don't know what to do or where to start. So this show today is exactly for you if you have those questions. So how to start investing? I would say step one is deciding what you want to save for. What is important to you? What is your goal? What are you trying to save more? Saving is a whole lot more fun if you have a purpose behind it, if you have a goal behind it. So step one, what do I want to save for? That can be retirement, buying a house, paying for college for your kids. These are all correct answers. There's no wrong reason to start investing, but we need to have a purpose behind it. Like I said, it's a lot more fun to save for a purpose, but also the purpose is going to tell us what type of account we need to open. So once we decide what are we saving for, that then tells us what type of account we need to open. So if you wanted to open up a savings account or an investment account to save for college education for your kids, that's called a 529 college savings plan. So that's the type of account you'd want to open. If you wanted to save for retirement, you would open an IRA, an individual retirement account, or a Roth IRA, a Roth individual retirement account. Or if you just want to invest to buy a house or for the future or for a home renovation or for something, but it's not retirement or my kids' college, then that's what's called an after-tax account. But not to make it any more confusing, companies will give after-tax accounts different names. You may see after-tax account, you may see brokerage account, you may see individual TOD, which means transfer on death, which means if you were to pass away, that money goes straight to whoever you named to be the person that it's transferred to upon your death. So already it gets super confusing if you don't really understand or you're in on the lingo. It's confusing. It's, well, I want to open up this account, but then I have these options of what's a brokerage, what's an individual TOD, what's an IRA, what are all these things? So understanding what are you investing for, and then the corresponding account that fits with that type of goal. What is the cadence you'd like to invest? So deciding how often are you going to invest? Is it going to be, I'm going to do this monthly. I want this as part of my monthly spending strategy. I want to send $100 a month to this account or what have you. Deciding on the cadence. Or do you just want to have the account open and you can send money to it as you need to? Again, there's no right or wrong answer. And what I kept telling my fellow moms and writers is that you can't mess this up. If you make a mistake, it can be undone. Nothing bad is going to happen. It's okay. So don't worry about getting it wrong. One, you just really can't mess it up. So that's important to keep in mind when we are opening up these types of accounts or opening up an investment account. So now that we've decided what's our goal, what are we saving for, how often do we want to invest, and based on our goal, that then tells us what type of account we're opening. We're doing it. We're going in and we're doing it. But where do we go? Where do we go? What's next? So there's so many different options out there that you can invest at. eTrade.com, for example, Fidelity.com, Robinhood. Those are all places where you can open up these accounts that I talked about and start investing. So it's really just picking one and going with it. Take a look at their site. Do you like the look of it? Does it seem easy to navigate? Again, you can't mess this up. So even if you open up an account at Fidelity one day and one day you say, I don't really like this site, or I'd rather go somewhere else, it's okay. You can switch it. It's not a big deal. You can't mess it up. So picking a site and going with it, and we're opening up the account. So again, if the goal was, well, I'm not saving for retirement, I'm not saving for my kids' accounts, I'm saving because I feel like I should, because I feel like I need to start investing, that's generally a brokerage account or an individual account or a joint account if you want to own it with your spouse or partner. So you're going to be choosing the type of account that you're opening when you're creating the account on those sites. Step 4 is funding the account. So how are we going to have money enter this account, right? We open it up. That's kind of hard. That was a hard part. But now how are we going to fund it? So likely you're going to have to hook your bank account info up to the account, your checking account, or savings account. You'll need your routing number or account number for that bank account on how you're going to fund the account. Then the good news is that generally once that's done, it's done. You never have to worry about it again. And if you ever go into that account and want to add more money to it or make a withdrawal, your bank account's already hooked up. So again, some of these steps you just have to do once and then it's there forever. So we've decided why we're funding the account. We are setting up we're deciding on our cadence. So how often are we going to contribute to this account? What's the purpose of it? And then we opened it. And then we hooked up our bank account to it so we can add money very easily. Now we need to choose an investment. And again, you can't mess this up. But you want to make sure the only way you can mess it up is if you don't choose an investment at all and it's just sitting in cash forever, then you're not getting any growth. You're not having any losses, but you're not getting any growth either. So we want to choose an investment. And when you're starting off with likely a smaller dollar amount, we don't have to get super fancy. So there's so many different directions that we can go in when it comes to choosing an investment. But again, you can't mess this up. But we want to choose something that gets us diversified. We're not just picking one stock, right? Because then we're living and dying by that one stock. So we want to make sure that we're diversified, and we can always change the investment at a later time. We can add to it. So, but it's important to remember that markets go up, markets go down. But when markets go up, investors make money. So you may see some volatility in your account, and that's okay. You are investing for the long term. You're doing this for your future self. You're saving for a goal. So it's okay if you were to see your account value fluctuate when it comes to balances, but just know you're diversified and you're investing for the long term. So there's a few different types of investment vehicles. I already mentioned stocks. So a stock that's usually what comes to mind when we think about investing. We think of owning a stock, and a stock is essentially ownership of a company. So a slice of the pie. a slice of the pie of the company. So you're a very fractional owner of that company. And the stock price is based on quite a few different things, but the stock price varies when there's news about the company, if they do well, if they have good earnings, the stock price will go up. If the company has some bad press and earnings aren't doing too well, that's when the stock price goes down. So generally speaking, I don't recommend, if you're a new investor, to buy into stocks, because you're living and dying by that one company. That's a lot of pressure to know about a company to invest in. Instead, it's better off to get diversified. And a way you can get diversified is through a mutual fund or an exchange traded fund. A mutual fund are a bunch of stocks and bonds packaged together. A bond is like a loan. So a town, a municipality, for example, offers a bond at an interest rate. So what they're pretty much saying is, hey, we need money for roads, for schools, for all of these things. Can you loan us money? And then in exchange, we're going to give you an interest rate. So you're going to earn money on that. And then when the time period's up, so if we need to borrow your money for 5 years, we then give you back your money. So you got interest for a long period of time, and then you got your money back. That's a rather conservative way to invest, because you know exactly what you're getting as far as an interest rate, and you're not getting any more, any less, and then you're getting your money back. So that's a nice conservative way to invest through a bond. So a mutual fund is stocks and bonds packaged together. So they're in a nice, pretty package. They're created by managers. So if you were to use Fidelity, for example, Fidelity has managers that pick that create mutual funds, and they package the stocks and the bonds together. And all you have to do is choose the mutual fund. And oftentimes the fund, the name of the fund usually describes what the fund does. So if it's a growth and income fund, it's growing and it's giving a little bit of income. The income is from the bonds. The growth is from the equities. So we can do picking one mutual fund gets you diversified, and you don't have to think about it. You're not picking and choosing the stocks inside of the mutual funds. The managers are doing that for you. Or you can use an exchange traded fund. So we talked about stocks, which is like buying a piece of a company, a slice of the pie of the company. Bonds, which are like a loan, where you buy a town or a municipality where you get a fixed interest rate. Or we have mutual funds that package all of those two things together, equities, stocks, and bonds together. And all you have to do is pick the mutual fund. Or you pick an exchange traded fund, an ETF. I like ETFs because they track an index. If you were to look on the news and you see the S&P 500 or the Dow Jones, and it's red or it's green, and well, what is all of that? They're tracking companies. They're an index. They're tracking companies. ETFs were created to mimic what the indices do. So what the S&P 500 does, an ETF was created to track it. So the S&P 500 has 500 companies in it. So by buying a S&P 500 ETF, you're essentially getting the slice of pie of 500 different companies, and you're following the index. I like ETFs better than mutual funds because they're less expensive. They're easier to see what's in them. You can crack an ETF open and see exactly what's in it at any point in time. And you can buy or sell an ETF at any point throughout the day. Mutual funds, you have to wait till the end of the day for it to sell. You could request it to be traded at noon, but it's actually not going to sell until the market closes, and the price could actually vary during that period of time. So again, at this point, we can't mess this up. We're choosing what ETF mutual fund we're investing in. And again, we can just Google this. We don't have to overthink it. We're not going to mess this up. So if for example, you say, well, fine, well, let's do an S&P 500 ETF. You can Google best S&P 500 ETFs, because there's a whole bunch out there. And then you see the ticker. So for example, the Vanguard S&P 500 ETF, the ticker is VOO, and the ticker is a 3 or 4 character symbol. And when you buy an investment, you're entering that ticker in there, because every investment, every mutual fund, every stock, every ETF has its own ticker that we use to identify, the market uses to identify the investment. So the ticker is what we use to identify the investment. Every stock, every bond has its own ticker. Every ETF, every mutual fund has its own unique ticker, and it's assigned exactly to that investment. So when you invest in when you're choosing your investment and on Fidelity, on E-Trade, you're picking that ticker and entering that ticker in there. And that's telling Fidelity or E-Trade, for example, how to invest your money. So now we have our account set up. We have the purpose. We have the type of account. We have the investment chosen. We entered the ticker. Now we sit back and we let the magic happen. If we have a automatic contribution into the account, we're letting that happen, and the contributions leaving our checking account, going into our investment account and being invested. And now you're watching your money grow. Ideally, sometimes it's going to go down a little bit, but ideally it's growing. And it's going up and down, and your money's continuously being invested in the account. And then once your account builds up, that's when we can add new investments in there, add maybe another ETF, another mutual fund in there to even further diversify you. But you've got started, and that's the most important thing. So hopefully that gave you some insight and the strength and confidence to go in and start your own investment account. If you have any questions, you want someone to do this for you, you'd say, you know what, this all sounds great, but I'd rather just have a financial advisor do it for me. I'm here to help you. You can visit my website at gwawealth.com. and schedule a call with me, and we can talk out what your goals are, what you're looking to accomplish, and I can help you put a plan in place to achieve your goals. You'd never have to feel like you're going at it alone. This was more for those DIYers that wanted to do investing themselves, but you always have a financial professional in your corner. I'm here to help you. So you can visit my website, gwa.com, to not only schedule some time with me for us to get to know each other, but also listen to my other podcast episodes, read my blogs. Please like or review this episode if you enjoyed it, and I'll see you next time. Ever wondered how to secure your financial future? Introducing Financial Foundations, the ultimate financial planning program. Take control of your money, plan for the future, and build a secure financial foundation. Join us on a journey to financial freedom. Visit greenwaywealthadvisory.com today to start your path to a brighter financial future.